This recording is going to focus on the non-financial objectives of an organisation. Now, non-financial objectives is really far-reaching. It can be a whole range of things in there, metrics that a company would want to look at. For example, employee turnover, staff motivation, customer satisfaction, client retention, loads and loads of different things, depending on the stakeholders of the business. Now, for the purposes of this recording, we're going to look at specific non-financial objectives that companies are guided to report on. So the first of those is integrated reporting, also known as the capitals. And this is some high-reaching guidance that larger companies are supposed to take into account when deciding what to include in their financial statements. I'm not talking about the numbers at the back. I'm talking about the bit at the front, the director's statement, the director's report, where they're updating you on what's happened in the business. We'll then have a look at an example question to see how integrated reporting is examined. And then we're going to look at something very closely related to integrated reporting, the Global Reporting Initiative Principles. So this is a separate set of guidance, but it is very closely related to integrated reporting. Integrated reporting then, known to its friends as the capitals. So this is just guidance, it's not mandatory, but organisations are encouraged to report on the 6 drivers of value, which are known as the capitals, and these are the things that, if you get them right, it should really help to push your business forward. The first of these is financial, so reporting on things like total shareholder return, the amount of dividend and capital growth that you've provided to shareholders. Intellectual capital, so what is the company spending on R&D, for example? Social and relationship capital, how are you interacting with the organisations around you? And are you developing those relationships in a sustainable way to help to build for the future? So a nice example of that is how long are you taking to pay suppliers? If you're a large organisation, you could squeeze your suppliers and pay them slowly, but that's not necessarily going to develop a long-term relationship with them. That could even push them out of business. It's a bit cutthroat. Actually, if you're paying them within a reasonable amount of time, you're more likely to sustain a good structure and supply chain around you. Next, human capital. How are you developing your people? And a nice metric for this is employee turnover, because if you're motivating your staff, if you're developing your staff, they don't tend to leave. Manufactured capital. What tangible assets have you bought or developed? So CapEx spend, for example, capital expenditure. What capital items have you bought, like plant, for example? And then finally, your natural capital. How are you interacting with the wider environment around you? And a metric for that is your carbon footprint. So those are the 6 capitals which you need to know and have a bit of an idea of what goes into each one. Here's a little bit more on those capitals and how they link together. This diagram is really useful to show you how they are interwoven. They don't exist separately. So financial capital is linked to all of the others. You require funding and you get return from all of the different areas of the business. That R&D spend within intellectual capital, you need money to be able to do that. But if you don't spend on R&D, then you won't generate enough of a return to pay for your shareholders. Some good links between financial and intellectual. Manufactured capital, so our example there is what were we spending on CapEx, but it could be what we're making in terms of tangible assets. Well, that draws on lots of different places. You need money to make things, so link with financial capital, but you also need people, the human capital. You also you're likely to need to interact with those outside of the organisation, so suppliers of things, for example, that's social and relationship, and there may be some R&D spend required to develop the knowledge to be able to build these things, so intellectual capital. And natural capital, our impact on the environment, well, that's influenced by all of the capitals, hence it sits around and encompasses all of them. Let's now look at a question to see how this comes up. So we're told in this question, capitals are the resources and relationships that are used and affected by an organisation, and they're identified as financial, manufactured, intellectual, human, social, and relationship and natural capital. So those are the 6 capitals listed out for us. We haven't really been told anything there, have we? And here's the question. Choose the statements that are true regarding the framework classification of these capitals. Select all that apply. Oh, I hate these ones. When it's select all that apply, that means it's a series of yes/no questions, isn't it? It's not just pick out the correct one. So what have we got then? Firstly, companies have to cover all 6 capitals in their reports. The framework helps organisations to consider their wider societal impact. It's mandatory for listed companies to adopt the framework. And applying the framework should reduce reporting costs. Okay, that's it. Just 4. So each one you've got to decide whether it's true or false. Pause the recording and have a go for yourself. Right, let's look at these together then. First one. Companies have to cover all 6 capitals in their reports. No, it's guidance, isn't it? So you might choose to cover just 3 or 4 of them if some perhaps aren't particularly relevant to your industry. So you don't have to do anything with this reporting. So that's not true. Second one. Framework helps organisations to consider their wider societal impact. Now, I like the sound of that one because I can link that in with 2 of the capitals. Natural capital, my effect on the environment, and also my relationship capital as well. That's about my interaction with other parts of the supply chain. It's mandatory for listed companies to adopt the framework. No, it's not. We've said everything about this is guidance, so you don't have to do it. Applying the framework should reduce reporting costs. Well, actually, I think that's likely to be the opposite. Because if I've got to report on all these extra things, all this extra stuff has got to go at the front of my financial statements, then I've got to generate the data that's going to go into that. So tracking these things is probably going to cost me money rather than saving me money. So only one of these sounds reasonable to me. It's that second one. The framework helps organisations to consider their wider societal impact. And it does.